All right, and they've just come out. I'm just pulling them up here. Their revenue came in at, as it's loading for me, at $1.212 billion. So that is going to come in ahead of expectations. Expectations were calling for that to be at $1.08 billion. As far as their operating income, I'm scrolling down here through their net loss margin. They have a net loss of 209. Let's see, they've converted to EPS here as we scroll down through here. Operating income margin is down to 2%, though, which was 20% in 2024. So that will be a number I think people are very focused on here. The revenue, again, coming in ahead. Now, their loss for the second quarter is 60 cents. The estimated loss was not expected to be 60 cents. As the numbers I'm looking at calling, they were expecting 46. We were expecting 23 on that. EBITDA margin coming in right in line at 62%. Estimated was for 61.9%, but they did post a pretty substantial revenue beat of about $200 million here. What are and as we look at the 2Q net loss here, $267 million overall. Estimated loss was $241.3. So a greater loss than expected there. Jeff, I'll come to you first as we get these numbers. A revenue beat, but an EPS miss here.
Yeah, I mean, the market is reacting slightly to it, a little bit up, coming kind of back down to where they closed at. But I think the revenue beat is obviously fantastic. Again, I think the market had high hopes going in this, higher than just what the expectations of the street was. So coming in above 175%, which was expected in terms of year-over-year growth, I think is fantastic. The loss, certainly, the earnings per share loss being higher, not what you want to see, but I think if you can justify it based on the expansion and everything else we're seeing, then investors will probably look the other way for that one.
And Kevin, I want to come to you here too. For operating income, this number just coming through at $19.2 million. The estimate was for $43.8 million. So, some interesting mixed numbers coming in. What are your thoughts here as we see now we're going down about 2.5% as more numbers come out?
Yeah, it's going to be volatile. Well, look, we're not even going to get their estimates or their quarterly guidance until the conference call, so we got to hold our breath as these numbers kind of hit the tape here. When you're looking at the quarter, I would say it's a little bit mixed, but it's not too bad. Actually, if you look at it on a year-over-year basis, their comps are actually better than what we saw this time last year. And so that's obviously going to be a bright sign. They were the first ones to actually have the availability of Blackwell within their suite or their enterprise suite. That's also going to be a tailwind for them here in the near future. They did talk about bringing a new hyperscaler customer that they signed for the quarter. They don't name who it is, but that's also interesting. Maybe we hear something around that relationship on the conference call here. And they talk about a couple of other achievements for the quarter. They also raised some capital by issuing some notes or some debt. Yes, obviously, is that a little bit of concern? Maybe, but it's a growth company, but there was a very strong demand for that debt as well. So you have to kind of weigh the pros and the cons here, issuing new equity, looking for new capital from investors, or issuing debt. Whatever's cheaper is probably going to be the best route for them at the moment. So this seems like a good quarter. I'm looking for the conference call, looking at the guidance moving forward. We just don't have that guide. And I think the guide probably will rapidly readjust the price action that we will see either to the upside or downside over the next hour or so.
Yeah, and certainly it will. Kevin, you just brought up it is a growth story here. Their EBITDA for the quarter coming in at $753.2 million, which was better than expectations for $675.7. But certainly from the increase from last year was at $249.8. So if growth story is the argument, they are growing at a rapid rate. Jeff, the question is it rapid enough?
Yeah, and I think, I think Kevin's made some excellent points on this, which is we're seeing this debt come in. It is something to be concerned about, and I think investors need to keep their eye on it. At the same time, it points to the fact that the company needs to meet this high demand. They need to be able to expand at this level, right? They're operating those 33 data centers in the U.S. and Europe right now. We know that there's been talks about partnerships. You've probably read some about the Core Scientific potential takeover. There's been opposition to that, but that sort of thing could really help springboard this company and maybe even cut down on some costs. So investors are going to pay close attention to that. And again, growth story, there's some concern, but I think we're seeing an okay reaction right now.
Well, Jeff Pierce, Kevin Green, thank you for helping us break down CoreWeave. I do want to bring in George Tsilis into the conversation as we take a look at Cava's earnings. Cava shares tanking right now, down about 18%. They cut their outlook on a weak second quarter as consumers face what they are calling fog and uncertainty, George. Walk us through some of these numbers.
Yeah, I mean, on the surface, I'm just going to look, first off at the trend of Cava, going back to December of last year. I mean, Cava, Sweetgreen, Chipotle, for that matter, are down. So that speaks perhaps to what's going on in the industry space. And I think these numbers also follow suit with what's going on with the underlying trend in the space. But it looks like at the very least on an adjusted EPS front, they posted 16 cents. That did beat the 13-cent estimate that they were expecting, but that was still down about a penny compared to last year of 17 cents. And the other thing you got to keep in mind is even last quarter, the company posted 23 cents of adjusted profit. So that was sequentially down and year over year down. Top line sales look like it missed fractionally. I have here 280.6 million. Correct me if I'm wrong. But at the same time, the estimates were close to 286 million. Now that was still down sequentially from last quarter, 331 million, but also higher from the 234 million for the same quarter last year. And I think the challenge is if you look at the business, first off, they've been growing quite significantly, 382 stores, 25 states. They have a goal between this year and 2032 or 7 years for essentially over 1,000 units. Irrespective of the fact that net income margins for this business are quite high, maybe even comparable to CMG, which is a much larger business, both in sales and volume. The growth rates are insufficient compared to the earnings multiple. I think that there's a stretch valuation for Cava. Prior to today's afternoon announcement, the stock was already trading at 141 times this year's earnings, and even next year's earnings at 116 times. So that's just, I suggest, perhaps lofty valuation that's adding pressure to the shares, quite a bit of pressure, down about $15 or so in the after hours.
Yeah, and as I'm looking through, very weak same restaurant sales here. They launched some expensive menu items with this grilled steak menu options and lowering their guidance, their same restaurant guidance, 4 to 6% down from the previous forecast of 6 to 8. Wall Street was expecting 7. Are you at all surprised by this, George? We did see Sweetgreen also post a decline, but we saw Shake Shack deliver some revenue growth, and we saw Potbelly report some revenue growth. They topped estimates, but then Shake Shack traded down after their results, and Potbelly traded up almost 13%, if I remember correctly. So is this a surprising result for you?
Well, I'm not surprised by the price action, to be honest with you. I think that if you just consider the growth rates, which are still in the 20% range for Cava in terms of sales, you basically have to demonstrate a higher earnings yield over time. You need a higher rate of change, and that's not been the case this quarter. And like I mentioned, the reason I brought up the sequential quarter-over-quarter decline is, typically restaurants don't do as well in the hotter months of the year as people are, barbecuing or doing other things. That might explain the quarter-over-quarter decline estimates, which were expected to be down, for 13 cents versus 23 last quarter. But nonetheless, the year-over-year comps are down. And that also aligns with same-store sales weakness. So anytime you see same-store sales weakness, that equates to weakness in operating leverage. So they may be growing their total footprint, and that's fine. That's increasing their top-line sales. Again, it was a slight miss here by about $6 million or so, roughly speaking. But, you can't grow your business just in top line sales unless you're growing it more efficiently through operating leverage, and that's same store sales. And I think that's the primary challenge here for Cava. And then you add in the bigger issue, I suggest, is already trading at very lofty valuations. I was quite surprised to see that it had been trading at these levels, irrespective of the fact that it's already down year to date prior to today's after hours move, 26%. In the last year, also 52 weeks, stock is down 5%. So it is a growth story, but it may not be growing at a reasonable price, irrespective of the fact that they have pricing power and margins have been high. Their same store sales growth has been challenged.
And with that growth, they are also working with this hyphen company, this kitchen automated food production service. They announced this could be a $10 million investment here. Chipotle also potentially working with them. Do you think that has the possibility to give them a boost? Is that a potential positive as it could, help with their digital to-go orders and create some more efficiencies that are clearly needed to help boost sentiment here?
Yes, I do. I think that's going to be positive for the business. That'll improve their operating income going forward, but it may be a couple of quarters, even a few quarters between the time they implement the CapEx, new technologies, train their workers, and then get more scale out of those technologies. So that's going to take some time. And I think between now and that, you just have to go with the underlying trend, which is already suggestively lower. And again, the valuation is relatively rich, and that's adding additional pressure in the after hours. Now it's close to $20 to the downside. So again, I'm not surprised to see this down because of the fact that they essentially came in slightly lower on revenue, higher on at the very least EPS. But if you just compare the numbers quarter over quarter, year over year, they're both down. So there was already underlying pressure going into this earnings. And then again, the revenue miss just adds more to that because of the valuation expense.
Well, George, we appreciate you breaking down Cava with us. Cava shares down about 21% right now on an EPS beat, 16 cents versus the 13 expected. Revenue missed just slightly, coming in at $280.6 million. As for CoreWeave, which we covered before this, shares down about 7.5% right now on a loss of 27 cents. Greater than expected. Revenue coming in ahead, though, at $1.21 billion versus the $1.08 expected.